150,000 tax notices. That's how many have landed in NRI inboxes in recent months, according to reports. And most of the people who received them had no idea they'd done anything wrong. Welcome to the NRI ledger. Here's what changed. India's tax system doesn't rely on you declaring things anymore. Every bank interest credit, every mutual fund sale, every property deal is reported automatically into a system called the Annual Information Statement. And software matches it against your return. When something doesn't line up, a notice goes out. No officer, no discretion, just a database. And from April this year, a new residency rule quietly reclassified thousands of NRIs as taxable in India without them realizing it. Today I'll walk you through the 7 reasons NRIs are getting notices right now, the real-world case patterns, and the exact fix for each. Before the July 31st filing deadline. This is education, not investment advice. Let's open the ledger. Reason 1. The 120-day trap. For years, NRIs planned around a simple number: stay under 182 days in India, and you remain non-resident. But from April 2026, there's a second tripwire. If your income from Indian sources crosses 15 lakh rupees a year, your safe limit drops to just 120 days. Cross it, and your residency status changes. Not fully resident, but enough to change your tax position. Here's the case pattern. A Dubai-based consultant spends 4 months in India managing family property and a rental portfolio worth 20 lakh a year. He counts 125 days, comfortably under the old limit, over the new one. And the system knows, immigration records and PAN data are linked. The fix is simple discipline. Keep a day count log backed by passport stamps and boarding passes. Plan your India trips against the 120 line, not 182. And if you're anywhere near both the day limit and 15 lakh of Indian income, get your residency status assessed before you file, not after the notice arrives. Reason 2. Deemed residency. This one catches NRIs in 0 tax countries: the UAE, Qatar, Bahrain, Monaco. If you're an Indian citizen earning more than 15 lakh rupees from Indian sources, and you're not liable to pay tax anywhere in the world, India now deems you a resident, even if you never set foot in the country all year. Case pattern: a Sharjah businessman with 18 lakh of rental and dividend income from India. He pays no tax in the Emirates, because there is none. Under the deemed residency rule, India claims him, and a notice asks why he never filed as a resident. Now, the good news. Deemed residents are treated as resident but not ordinarily resident, RNOR. Your foreign salary and your foreign business income stay out of India's net. Only the Indian source income is taxed. The fix. If you live in a no-tax jurisdiction and your Indian income is meaningful, file correctly as RNOR. Keep your income classification clean, and never assume that 0 visits means 0 obligation. Reason 3. The mismatch you didn't know about. Your bank reports the interest on your NRO account. The registrar reports every mutual fund redemption. Companies report your dividends. All of it lands in your Annual Information Statement, the AIS, whether you ever look at it or not. When your return says one number and the AIS says another, the computer raises its hand. Case pattern: a nurse in Toronto files a nil return because she has, quote, no income in India, forgetting the NRO account earning 90,000 rupees of interest, and the mutual fund she redeemed to help her parents. 2 mismatches, 1 automated notice. The fix takes 20 minutes. Before filing, log into the income tax portal, download your AIS and your Form 26AS, and reconcile every line against your return. If something in the AIS itself is wrong, and it happens, submit feedback on the portal instead of ignoring it. File what the system already knows, and the system leaves you alone. Reason 4. the bank account you forgot to convert. The rules are clear. The day you become a non-resident, your ordinary savings account is supposed to become an NRO account, and your fresh foreign earnings go into an NRE account. Thousands of NRIs never do this. They keep the old resident savings account running for years, a violation under FEMA, the foreign exchange law, where penalties can run up to 3 times the amount involved. And it cuts the other way too. NRE interest is tax-free only while you are actually non-resident. Move back to India, keep the NRE account, keep claiming the exemption, that's a notice. Case pattern: a returning engineer enjoys 2 years of, quote, tax-free NRE interest after settling back in Bengaluru. The AIS catches the interest. His return claims an exemption he no longer qualifies for. The fix: redesignate your accounts in the same month your status changes, in both directions. And if you've left it late, correct it proactively. Banks have standard processes for exactly this situation. Reason 5: property deals. Real estate is where the biggest NRI notices live, because the amounts are large and the reporting is automatic. Selling? The buyer is legally required to deduct tax at source, at 20% plus when the seller is an NRI. But many buyers deduct just 1%, as if you were a resident, and the shortfall becomes everyone's problem. Renting? Your tenant reports the rent. If it's not in your return, that's a mismatch. Even buying property above 30 lakh gets reported to the department by the registrar. Case pattern: a London-based owner sells a Chennai flat. The buyer, unaware of NRI rules, deducts 1%. A year later both of them get notices, the buyer for short deduction, the seller for the capital gains trail. The fix: disclose your NRI status in every property transaction, upfront. Apply for a lower TDS certificate before the sale if the standard rate overtaxes your actual gain. And report every rupee of rent your tenant already did. Reason 6: not filing at all. There's a persistent myth that NRIs don't need to file Indian returns. The truth: if your Indian income crosses the basic exemption limit, or tax was already deducted and you want it back, filing is either mandatory or very much in your interest. Banks deduct 30% on NRO interest by default. Without a return, that money is simply gone. And the department watches high-value transactions even from non-filers, large deposits, big credit card settlements, property registrations. Case pattern: a Singapore-based analyst skips filing for 3 years. My TDS is already paid, he says. Then a property purchase flags him as a high-value non-filer, and he's asked to explain 3 years of transactions at once. The fix: if there's Indian income, file. For most NRIs it produces a refund, not a bill. And check the compliance section of the portal once a year. If the department has flagged you as a non-filer, respond there, before it escalates. Reason 7: treaty claims without the paperwork. India's double taxation agreements are genuinely generous. Lower tax on interest, relief on pensions, credit for tax paid abroad. But every treaty benefit stands on one document: the tax residency certificate from your country of residence. Claim treaty relief without a TRC on file, and the claim is disallowed the moment anyone checks, often years later, with interest added. Case pattern: an accountant in Doha claims treaty relief on his NRO interest for 4 straight years, no TRC. No Form 10F, the claims sail through. Until a review pulls all 4 years at once, and what would have been a simple certificate each January becomes a 5-figure demand. The fix: obtain your TRC from your local tax authority for every year you claim treaty benefits, file Form 10F on the Indian portal, and keep both with your return records. Treaty relief is your right, but only if the file says so. The ledger verdict. 3 actions before July 31st. 1. Download your AIS and reconcile it line by line against what you plan to file. 90% of notice risk dies right there. 2. Count your India days for the year, with evidence, against the new 120-day line, not the old one. And if you're in a zero-tax country with 15 lakh plus of Indian income, run the deemed residency test. 3. Fix the paperwork, accounts redesignated, TRC obtained, every rupee of rent and interest disclosed. None of this is dramatic. It's bookkeeping. But in a system where the computer reads everything, clean books are the only real protection. If this helped, subscribe. In the next episode, we break down exactly how deemed residency is calculated, with worked examples. This is education, not investment advice. See you in the next ledger.